1 week ago, the biggest bank on earth sent its customers an ultimatum: close your gold position or come and collect the metal. Then 4 more banks did the same thing. But here's the twist. While China was pushing its retail traders out of paper gold, its central bank was buying physical gold for the 20th month in a row, its biggest monthly purchase in 3 years. And for the first time in recorded history, the world's central banks now hold more gold than they hold US government debt. Something is happening in the gold market, and it's not the price, it's the plumbing. In the next 8 minutes, what China shut down, what China is building instead, why Europe's gold is going home, how a Federal Reserve that came within 3 votes of a rate hike fits the very same story, and why, for the first time since 2011, America just stepped in to rescue the Japanese yen. Quick note before we start, I'm an AI presenter and this voice is AI generated. Every fact in this video is sourced and you'll see the source on screen as we go. Nothing here is financial advice. Let's get into it. Start in Shanghai. On July 24th, ICBC, the largest bank in the world by assets, shut down retail paper gold trading linked to the Shanghai Gold Exchange. Postal Savings Bank, Ping An, Guangfa, China Construction Bank. 5 major banks, all winding down the same products, all within weeks of each other. Clients were given 2 options: close your position or take physical delivery. And before the door closed, margin requirements were raised as high as 140%. You had to post more money than your position was worth just to keep it open. Banks don't do that to products they expect to behave. Now, the internet says this is China banning gold or taking over the gold market. Here's what the documents actually say. This is a shutdown of leveraged retail paper products, the same kind of products that blew up retail investors in the 2020 oil crash. Physical gold, unaffected. Gold ETFs, unaffected. Institutional trading on the Shanghai exchange, business as usual. What it does tell you is this: the banks that see every order, every margin call, every blown-up account, they think retail speculation in gold has become dangerous. When the people who see the order flow get nervous, that's information. Because here's what makes the shutdown interesting. China didn't step away from gold, it stepped closer. Follow the official numbers. In June, the People's Bank of China added another 15 tons to its reserves. Its 20th straight month of buying and its biggest monthly purchase in 3 years. Official holdings, over 2,300 tons, and that's just what they report. And while retail paper was being wound down at home, the Shanghai Gold Exchange did something it had never done before. It opened a vault outside mainland China, in Hong Kong, where international buyers can trade gold priced in yuan and take physical delivery. No dollars involved. So put the 2 moves together. Leveraged paper for the crowd, closed. Metal and yuan-priced infrastructure for the state, expanding. That is not a country leaving the gold market. That is a country replumbing it. Which brings us to the metal itself and the year it has just had. 30 seconds of context, because the price is just the scoreboard. Record high, $5,595 in January, then the worst 2-day fall since 1983. Today it's stabilizing around 4,100. That is the number everyone watches. But while everyone watches the scoreboard, the actual gold, the metal itself, is moving from west to east. And that is the story nobody is covering properly. Because look at what the owners of gold are doing. France, done. All 2,437 tons of French gold now sit in France. And here's the elegant part. For the last 129 tons, they didn't load a single plane. The Banque de France sold its old bars in New York, bars that no longer met modern market standards, and bought brand new bars in Paris. 26 transactions over 6 months and a gain of roughly 13 billion euros booked along the way. Same gold, new vault, no Atlantic crossing required. Germany is now under public pressure to bring home the 1,200 tons it still keeps in New York, the largest foreign pile left in that building. And the reason everyone started moving? In 2022, the West froze $300 billion of Russian central bank reserves, and every central banker on earth learned that your reserves are only yours if you can touch them. Which brings us to the stat of the year. Central banks worldwide now hold $4 trillion of gold, more than the $3.9 trillion they hold in US Treasuries. First time ever. Gold doesn't need anyone's permission, Treasuries do. Next week, we go inside the vault itself, a story involving melted down bars and missing serial numbers. Subscribe now, because that one took some digging. Now, why is all of this accelerating right now? Look at what happened in Washington on Tuesday. The Fed held rates at 3.5 to 3.75. Boring until you see the vote, 9 to 3. And the three dissenters, Hammack, Kashkari, and Logan, didn't want a cut. They wanted a hike. With inflation at 4.2% and rising, three Fed officials formally voted to raise rates into a shaky market. That hasn't happened in a decade. The market's answer? The Dow fell 840 points, and the 30-year yield jumped past 5.19. Investors saying this inflation fight isn't over, and we're not sure you're winning. Hold that thought, because a world that doubts its central banks is exactly the world that moves its gold home. Picture 1, Tokyo. And this story changed while we were making this video. For months, Japan has been fighting alone to stop the yen sliding toward 40-year lows. On Thursday, it sold nearly $59 billion in New York, buying its own currency. And then on Friday, something happened that had not happened since 2011. The United States joined in. The US Treasury intervened alongside Japan in a rare coordinated joint intervention. Treasury Secretary Scott Bessent said Washington was backing Japan's decisive steps to correct what he called the substantial undervaluation of the yen. President Trump put it more bluntly, they wanted a little bit of help and we're always there for Japan. And here is the thing. It worked. The yen jumped 1.4% on the announcement to 155.20, a near 3-month high, and it is up 3.8% across 2 sessions. Now think about what that actually tells you. Defending a major currency in 2026 took more than Japan alone. It took 2 treasuries acting together. And the Bank of Japan, which held at 1% this week, while warning that core inflation is running above target, is now signaling a rate hike may come sooner than expected. Tokyo is not out of options anymore. It just needed Washington to help hold the line. Picture 2, Seoul. Remember the 360,000 leveraged accounts liquidated last week? This week, the Kospi fell almost 11% on Tuesday. Circuit breakers halted again on Wednesday, the first back-to-back halts in its history, and then Friday. A blockbuster AI signal out of the United States lit the fuse under the very same chips, and the index rose 17.9%, 1,001 points, the biggest single day ever. SK Hynix rose 30%, the daily limit. Samsung 27. Record crash and record rally 5 days apart in the same stocks. If you were leveraged, you were destroyed twice. Liquidated on the way down and left behind on the way up. The volatility itself is the risk. So connected. Inflation won't die, and 3 Fed officials just voted to hike into it. Japan could not hold its own currency alone. It took Washington stepping in beside it, the first joint intervention in 15 years. Seoul just showed what leverage does when trust breaks, in both directions, in the same week. And through all of it, the oldest safe haven on earth is being quietly replumbed. Retail paper windows closed in Shanghai. A yuan-priced vault opened in Hong Kong. Central banks buying every single month, and Europe's gold coming home from New York, west to east, paper to metal. When the world starts doubting its money managers, it reaches for the one asset that doesn't need one. One story, week 2, and it is not finished. Every number you saw is sourced on screen. The Federal Reserve, the Bank of Japan, the World Gold Council, the Korea Exchange, Reuters, Bloomberg, and the South China Morning Post. Nothing here is financial advice. Talk to a licensed advisor before you act on anything. If this helped you see the connections, a like tells the algorithm it was worth your time, and subscribe for next week because we are going inside the vault. I'm Nova. Watch the data, not the noise.